Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at market performance. We're also going to look at signs that the US is slowing, even though we're seeing indications that Europe and Japan are accelerating. We're going to start off with market performance. It's been a pretty strong 6 months for global equities, despite the war in Iran. Over the past 6 months, global equities up around 11%, and US equities not far behind, up around 10%. In fact, if you have a look at the last 1, 3, 6, and 12 months, US equity market performance has been pretty similar to global equity market performance. The standout performers over the past 12 months has been emerging markets led by South Korea, Japan, and South Africa. Japan has been a non-consensus story, or it certainly was a few years ago, but the attempts at structural reform seem to be paying dividends, so to speak, and as a result, we're seeing some pretty strong performance out of Japan, and we expect that there'll be more to come. And emerging markets led by South Korea, it's part of the AI trade, and that's seen some very strong returns in the South Korean market, and that's resulted in emerging markets giving a very strong return, 42% over the past 12 months. The SA story is quite interesting. If you look over the past 12 months, the South African market has done 30% in dollars. But over the past 6 months, the SA equity market has been very weak. The South African market typically doesn't respond well during times of crisis. And what's interesting, though, is as the war in Iran started, the SA equity market pulled back quite meaningfully as precious metals pulled back and as the oil price spiked. Even as the oil price has come down, we haven't seen a commensurate rally in the SA equity market. And that's in part because precious metal prices continue to be weak. Even so, and this is the interesting part, we have seen a very strong dollar over the past 12 months, 6 months, 3 months, and 1 month. In addition to that, we've seen a strong rand relative to the strong dollar, the rand strengthening against what has been a buoyant US currency. So we've got the situation in SA, which is quite interesting, where the rand has been very strong despite weaker precious metal prices. And the precious metal prices have affected the stock market, but not necessarily the currency. It suggests that there's been a sizable improvement in perceptions of SA-specific risk, allowing the rand to strengthen due to structural reform and improvement in SOEs, despite a weak precious metal environment. And we think that's a key theme. And the question is, at what point does this improved confidence about SA start to be reflected in SA Inc. shares? Right, shifting to the US, we saw the non-farm payrolls numbers come out last week. They missed expectations. They came out of 57,000. The consensus was 113,000. But in addition to that, the prior 2 months were revised down by more than 70,000 as well. In addition, if you look at the 3-month average, and we think you should look at the 3-month average given how volatile these numbers are, the 3-month average rolled over to, in broadly speaking, it's the indications that this was a weak print. It was a bit lower than expectations. It suggests a bit of a trend, but you do need to wait a little bit given the extent of recent revisions before we can attach too much weight to this print. So we'll look at it again in a month's time once we get the revised estimate. But at the margin, it suggests a slightly slower US economy, despite the fact that the unemployment rate in the US dipped a little bit. And just reinforcing the notion that US growth is slowing, we saw an update from the Atlanta Fed over the past week, and they've revised down their growth estimates for Q2 from 2.5% down to 1.2%. A sizable downward revision, and when considered in addition to that non-farm payrolls number, it does suggest that there's mounting evidence that US growth is starting to slow. And what's interesting is after that number came out from the Atlanta Fed, we still saw a subsequent rally in equities in the US. And it does suggest that equities in the US are not taking their read from GDP estimates. They're really taking their read from earnings numbers, which continue to be strong. And there is this continuing mystery which needs to be resolved, which is the continuing strength in earnings numbers coming out of the US, despite what up until now has been pretty okay average GDP prints. As an example, in last quarter, earnings growth close to 30%. There were some once-offs in that. You strip that out, you're still looking at earnings growth that's around about double digit in an environment where GDP growth is significantly below that. So you've got earnings growth outpacing GDP growth, and it has been doing so for some time. The GDP data does matter, however, for the US bond market. And it's quite interesting that post that downward revision from the Atlanta Fed, the US long bond yield increased. It didn't increase by much, but it increased nonetheless. And that, again, in the back of our minds suggests that there is still this residual concern around US treasuries as a safe haven asset. And should it be the case that the US economy does continue to slow, early indications, and it is very limited amount of data here, but early indications suggest that treasuries might not provide the sort of defense that they did before. Switching to Europe, in stark contrast to the US, there's signs that European growth is accelerating. If you look at the current consensus forecast, it's sitting at about 0.9% quarter on quarter for Q2. That's not annualized. And the latest nowcast suggests about 0.8%. So somewhere between 0.8 and 0.9% quarter on quarter growth expected in Europe, which would mean that European growth would be outpacing US growth. Bear in mind that Atlanta Fed GDP now estimate of 1.2% is annualized. That 0.9% for Europe is not. So if you're looking at like-for-like basis, you're looking at a much stronger growth. You're looking at somewhere between 2.5% and 3.5% annualized in Europe versus the 1.2% in the US, if the actual numbers come out in line with the current nowcast. In addition, there are other signs that European growth is accelerating too. For example, if you look at the leading index, that's now ticked up as well. Consumer confidence has ticked up too. And in addition to all of that, inflation has now declined, and that should take the pressure off the ECB with regards to hiking. It's a similar story in Japan. The leading index continues to improve. You're looking at a leading index that's now at the top end of the range of what we've seen over the past decade. And retail sales growth continues to accelerate too. And in addition to that, housing starts continue to be strong as well. So there's a broad range of data now suggesting that the US is starting to roll over and Europe is accelerating and Japan is accelerating. And that sort of narrative we don't think is being fully reflected in equity markets at this point, especially when you consider the returns we mentioned at the top of the presentation. And finally, on earnings. Earnings season in the US is just started. There's only one company in the S&P 500 that's reporting this week. Of the 16 that have reported so far, though, nearly 90% have beaten on the upside. And if you look at the consensus forecast for Q2, the current expectation is that earnings growth in the US is going to be 24% year on year. Again, very difficult to reconcile with the GDP numbers. But even so, earnings growth of 24% is very supportive of continuing strength in the US equity market, especially when you consider what earnings expectations are for the next coming few quarters, which are also above 20%. So in the back of our minds, we've got this continuing disconnect, which is a little uncomfortable between a mediocre to slow GDP growth and very strong earnings growth. The earnings growth supporting the US equity market, the weak GDP growth proving to be a headwind for fixed income. And we think this is likely to be a theme we're going to be talking about for the next few months, and we will update accordingly. That's where we're going to end for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.